Can family businesses, often seen as traditional, be successful in the fast-paced world of venture capital?
If you invest in under 10 deals, you are very likely to not succeed. If you invest in around 30, then even more chances are very high that you're going to have an outlier return or a few outlier returns.
That's just one of the many things that I learned at the Kongress für Familienunternehmen just the other week. And the more I dive into launching a VC fund from scratch, the clearer it gets the power law is real. At this family business Congress, I exchanged ideas with someone doing what most legacy companies only talk or dream about, bridging the legacy business of industrial scale with the speed of startups. This is the story of how one family business became a venture capitalist and what we can learn from it. On the way now to the conference, and today is going to be an interesting day because usually this conference is also flanked by a demonstration against capitalism, I guess. Not entirely sure, but I'm sure it will be against anything that this conference stands for, which is family business, which, yeah, funnily enough, family businesses are the backbone of the German economy. So if you're against capitalism in Germany, you really have to be against family businesses because they are the backbone. But I'm curious to see the extent of this demonstration, and I'm sure we will be well looked after. There is plenty of police to make sure everyone is safe, and it's a sign that democracy is working when you have demonstrations. I think that is totally okay and should actually happen if there are enough people who are of a certain opinion. So yeah, let's see what awaits us. Family businesses, the backbone of not only the German economy, but many economies worldwide. They're known for their tradition, their craftsmanship, and long-term values. But rarely are they associated with being at the forefront of technology. Most are aware of this, but few are bold enough to engage with the very industry where the future is being built, venture capital. To explore the question how to get started in venture capital as a family business, I spoke to Till Rösnick. Till runs an internal VC arm inside of the Wepa group. That's a 1.6 billion euro family-owned paper business. His job is to invest in industrial tech and climate tech startups that could transform their operations or disrupt their industry. That's an ambitious goal and an incredibly bold one, because to invest in startups that could transform your business, you have to be willing to be disrupted yourself. You have to open the door to creative disruption, and that takes real vision. To put into practice, Till utilizes direct and indirect VC investments. Direct VC investments, that means that the family business itself, through its holding company Wepa Ventures, invests directly into startups. Indirect investments, however, mean that they invest through VC funds and only hold the startup company shares indirectly through the fund. Here's Till explaining the pros and cons of each.
Direct investments, you have a nice and direct connection to drive transformation. Disadvantage is it's very hard to do profitable direct investments at scale. And then indirect investments, I mean, that you have a diversification, you have better average returns, and you have lower effort to manage a portfolio of indirect investments. But it's a lot of work to actually get access to the founding teams, and that's the disadvantage. The distance is higher and it's more difficult to actually have a transformational benefit.
This sounds simple enough, but what makes them successful? How does Wepa Ventures approach direct versus indirect venture capital?
We combine both, and I would say if I were to sum up our strategy, the first thing is we have a clear structure, and I mean strategy is always about what not to do, right? So we have a good focus, we know exactly what we do, and we also know exactly what we don't do, which makes it a bit easier for us to kind of roam through this enormous ecosystem of startup investment where we see 800 deals a year, right? So the first thing is we have a clear strategy, we have a clear structure, we have structured processes. So that's kind of the infrastructure we build around. I would say the second one is our unique position in the ecosystem. So we are an industrial player. We have a certain scale. So the family business, which is Wepa Group, has 14 different sites all over Europe. So we have a scale that makes us interesting for cooperation with us, and we have a good perspective on the market and can actually assess products quite well. So we have a very unique position in the ecosystem, and that's where the third advantage, I guess, comes in, or the third success factor, in my opinion. We are very close to both worlds. So I spend a lot of time in the family business. I would say we as a team have a good network inside the family business. So we know what makes them kind of stay up at night, what does actually drive tears in their eyes when it comes to pain points. And we can access that and can bring that together with investments. And we also have a good network in venture capital work, where we also spend a lot of time, where we also build very personal relationships to the managing teams, to the general partners, but also to the rest of the teams, to a lot of startup founders. And we can combine these worlds because of our network and actually the persons who are doing it, because it's a people game. People invest with people, and that's very difficult to scale. I would say these are the three success factors that make us different in this world.
Now, I mentioned this before. It's quite a big step for a family business to step into the lion's den and back companies that could potentially disrupt and even eliminate their very own business. That takes a rare kind of courage, the kind that says we'd rather be part of the wave than be washed away by it. But it's exactly that which makes these kinds of investments such a powerful tool for transformation. It's not just financial, it's philosophical almost. Family businesses that have been around for generations have learned to always adapt and change. Yes, they seem traditional at times, they build on a strong foundation, but embracing uncertainty and thinking in generations is exactly what has gotten them where they are now. And right now, it's about asking the question, what is the next big thing? And how do we make decisions today that will be pivotal looking back? Making venture capital investments is certainly not the only way to do this, but if you wanted to get started with venture capital as a family business, how would you do it?
First of all, whether you start with indirect or direct kind of depends on your strategy, and I would always combine them and then invest a lot of time in learning from your indirect investments. Second thing is, for indirect investments and direct investments, you want to build up a portfolio, and then this, and I guess this is the third thing to actually take away, this requires usually, more than 20 or more than 30 companies in your portfolio, direct and indirect mixed, and for this you need, 10+ million euros.
If you're a family business, or any business for that matter, and you are willing to confront potential disruption of your business model, the steps outlined in this video give you a very good idea where to start. You're thinking of buying into an early stage company that you just came across? Maybe that's a good idea, but more likely it would be better to first invest with a VC fund, indirect VC, so to speak. You have professionals that do nothing but exactly that. If you want to follow the journey of launching a VC fund from the ground up and learn the lessons that I'm picking up along the way, check out this video here.